This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we dive into the tech space as TikTok continues its fight against divestment in the U.S.
Plus, we take a look at new policy that could create some hurdles for future bank mergers.
But first, we talk transportation and the outlook for an airline acquisition that just got the green light from the DOT.
For more on the Alaska Airlines Hawaiian deal, we spoke with Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst George Ferguson.
I think it's a good deal for the U.S. consumer because I think there was a risk that potentially Hawaiian could have gone out of business. And so I think really what this whole thing adds up to is Hawaiian was a bit distressed. They've had some problems in their core businesses, especially from wildfires, Japanese travel, things like that. Have just hurt their core business. Their balance sheet was stressed. And so Alaska coming in and taking them over, assures that they continue to exist. The combined entity has a footprint that looks like, or a route network that looks like West Coast U.S. into Alaska, and then Alaska has some long haul into Asia. So it makes Alaska's operations a little more complex with some long haul, wide body aircraft. For most U.S. consumers, they're not going to really be able to tell, but I think the U.S. Department of Transportation, Department of Justice figured out that, like the Spirit JetBlue merger purchased by JetBlue, whatever you want to call it. I think letting that fail means that Spirit's in difficult straits. Hawaiian would have been in a similar place, and I think they've decided, let's just let this go.
Does this mean that the Spirit deal could get another look through, or that's definitely dead?
I think that's definitely dead from a JetBlue perspective. I'm not sure if Justice would think differently about it now, but I think it's dead.
George, what's the current status of just demand for air travel these days?
I mean, what we saw in 2Q was that budget travel definitely looked like it was taking more of the demand hit, although it looks like some of those travelers are fading a little bit. And I say although because we saw a bunch of capacity come to that marketplace, right? And I think really what we're starting to see in 2Q of this year was a fading of this bounce back travel boom where people were paying anything it took to go on vacation. And so I suspect we're going to continue to see that as we get into 3Q. We're actually working through schedules right now for the U.S. airlines as we do as we close the quarters down. And we're still seeing a decent amount of capacity coming to the marketplace. When I say decent, we were looking at domestic the other day, 5-6% growth in seat capacity, and you really can't do that in a market that the U.S. economy is growing a couple percent, and you don't have this bounce back travel. So we still think 3Q looks soft-ish. It's not as bad as 2Q. Some of the capacity growth isn't there. Interestingly, we're seeing more capacity growth come in from the big full-service carriers than we're seeing for the budget low cost. And notable are carriers like Southwest and JetBlue literally pulling back in capacity as they go into the end of the year.
Right, so you have the big guys are able to compete a little more on capacity and then price, and then the other guys can't, and that gets confusing. So this is a dumb question, but if I take a look at the big guys, can you rank these for me here? So you get the Delta, American, United. They're going to be the top three, right? What comes after that now?
Southwest. Southwest is number 4.
Okay. One
of the biggest carriers in the country.
And
then you go into the Alaskas, JetBlues, those folks, sorry.
So did Alaska and Hawaiian Airlines help them get a big boost? Are they in the top 5 now?
Well, Alaska is going to be 4 or 5, and JetBlue is going to be at 4 or 5. Well, Alaska-Hawaiian combination probably jumps them a bit above JetBlue. I haven't looked at this recently. JetBlue is going to be number 5 if they got Spirit, and those two are kind of neck and neck, so my guess is they're slightly ahead now, Alaska.
All right, George, what we got on your phone? We need our periodic update of Boeing. I know the most recent news was Boeing freezing hiring to preserve cash. And, what's the update on the strike and kind of where we are with Boeing?
So it goes on, obviously. Folks are talking. If it continues, I suspect that Boeing's draw off suppliers, their offtake of the components they're building is going to have to slow. To continue to preserve cash, I just don't see hiring doing that much for the cash flow of Boeing, because again, as it drags on, they have to start to really worry about how much cash they're burning. They would prefer not to go back to capital markets to shore up their balances. We think they're probably going to be close to $9 billion in balances as they end 3Q, and that's going to be pretty tight because that's roughly around what they say they need to run the company. I'm sure everybody can tighten their belt, every company can tighten their belt and get lower, but they need to be very, very mindful of cash burn here.
Yeah, I was like, ooh, that's treading the line there. We was talking to the guy over at Moody's who is putting the company at risk on downgrade. If they get a downgrade from like Fitch, S&P, and Moody's, what would that mean? That would be huge, a huge fallen angel, right?
Yeah, it's a big fallen angel. I mean, it's not the end of the world, right? Companies manage through this. No, I mean, it means that you're going to go to capital markets. If you go to debt markets, it's just going to cost you more to raise, right, your debt. And a company like Boeing needs this good mix of debt and equity to make the returns work for the equity. And so you kind of hate to be paying higher interest rates. You're going to see, some funds that are debt funds can't hold less than investment grade paper. They'll end up having to disgorge some of that Boeing paper. That means that you'll see prices gap out in it. Again, it's not the end of the world, but you prefer to be raising money cheaper than what they will be in the high yield markets. But customers, I don't think, go away because of it. Nobody can break their commitments for airplanes because of it. Suppliers don't really have other places to go for aerospace business, right? They could go to Airbus, which is investment grade. And Boeing has to continue to rebuild that balance sheet as they get things like this strike past them.
Our thanks to Bloomberg Intelligence senior aerospace, defense, and airlines analyst George Ferguson.
Staying with the transportation space, we move to the automotive world, where dealer sentiment is starting to wane.
For more on this, we spoke with Bloomberg Intelligence Global Director of Credit Research, Joel Levington.
The Cox Automotive folks put out a sentiment index, and it showed that it was the second lowest reading in their history, which is probably not great news. So dealers are thinking that there's going to be less demand for used cars, and that really goes back to affordability of vehicles. Didn't
Carvana do really well and is crushing on all cylinders, no pun intended?
Carvana is crushing it, and they should crush it again in the third quarter. But you have to remember, they're starting from such a weak spot that sometimes it becomes a case of less worse is great, and that's their case. For most of the other players, it's the opposite of it's just overwhelming the amount of cost that's associated with a car. Insurance is up 30%. Rates are 10-11% for a used car. So that's just weighing on consumers. So certainly rate cuts will be a benefit for them in the future.
One of the things you used to drive by a lot pre-pandemic, and there'd be cars as far as the eye can see. They had a huge inventory. And then during the pandemic, they had 3 cars on the lot.
Yes.
Literally.
Because nobody was building cars anymore.
Right.
Where are we today in that kind of scenario?
Yeah, well, 2 years ago, when nobody could build a car because there were no semiconductor chips to put in the cars,
that's right.
You had about 23 days worth of inventory. If you look today, that's up to about 56. Whoa. Now, historically, that's not bad, but I will tell you, depending on the auto company, if you go past Salerno Jeep out there in our area, you'll see it's outside the lot. They can't stuff enough cars in there. Jeep, Ram in particular, so the Stellantis company has a huge amount of inventory, Paul, and so they have also the highest discounts going on. They're discounting at about 5.5% on your average car, which is a huge amount for a company where your profitability might be 8 or 9%.
Well, we used to have a top auto analyst at Bloomberg Intelligence, and he explained it to me. Pre-pandemic, they used to make 17 change million cars, SAR, seasonally adjusted, something at really rate. Then that went down to the pandemic to way down, 14, 15 million. But they were more profitable sales at that point because they didn't have to offer incentives. Where are we in that production? It seems like they're kind of creeping back up in production.
Yeah, well, he was totally right in that you can play that game as long as inventory is low. Unfortunately, over the past year, all the, like we were saying, it went from 23 days then up to 46 days. Now you're up to 56 days. And now you have too much inventory on the lots to really play the game when your pricing is that high. An average car in America costs $47,000, and your average American family makes $60,000. So it's just, the math just doesn't really work out. And then you start hearing things like with Ally Financial, warning people. I think their stock was down about 20% on the news that auto loans for them are starting to tick up even higher than they expected in terms of write-offs. So I think we're going to be seeing more of that over the next couple of quarters.
I hate to say, you're painting a pretty grim picture for me about some of these car dealerships and like how they're going to kind of make it through all this.
Yeah, well, most of the dealers have enough financial flexibility that I don't think it's a case of them making it through. So at least the public companies, like that's really not going to be an issue. But what I do think you're going to see is resets in profitability expectations.
That hasn't happened yet.
That has not happened yet. I think you're going to first see that at the dealers, and that's going to eventually come back to both the suppliers and the OEM. So I would suspect that in the second half of this year, you'll see a reset in the auto universe for lower expectations for 2025.
You know, where are we, Joel, in the industry thinking out of Detroit and other big auto companies about this trend towards electric vehicles? It seems like we've hit a bump in the road after the initial success of Tesla. How do you think this is going to play out?
Yeah, I think it's going to take a lot of time, Paul, because even Tesla, you could say if you strip out the tax credits that they get for having for selling electric credits, they might not be profitable, or at least on a cash flow basis this year, out of the auto business. So it's a very tough business to get in. Right now, it seems like the market seems to be comfortable with hybrids, which gives you the best of having an ICE engine, but still giving you more green cars than a pure ICE engine. So the market's there. It's really the government has to either hugely change incentives or infrastructure, probably both. And that's not like a quarter or 2 quarter fix. That's a many-year fix. So my guess is they're going to have to reset their views as to what their goals are for the future.
Really quick, dumb question. Can you recycle hybrids? And what's that shelf life?
You can. There was an interesting story out just the other day on the battery technology that it goes down about 1 or 1.5% a year. So the batteries at this point are good enough that they could probably last the life cycle of a car. But you can recycle all of the componentry of the car, which will be a benefit down the road.
Thanks to Bloomberg Intelligence Global Director of Credit Research, Joel Levington.
Coming up, we're going to break down Intel's foundry expansion plans and its win with Amazon.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
After a recent flurry of bad news, slashing 15,000 workers, suspending the company's dividend, and shuttering the construction of pivotal factories in Germany and Poland, Intel's luck is looking up. Earlier this week, the company announced plans to create a custom chip for Amazon Web Services.
For more on the deal and the longer-term outlook for the company, Nora Melinda and I spoke with Bloomberg Intelligence Senior Technology Analyst Mandeep Singh.
Everyone knows their foundry business is burning a lot of cash. It lost $7 billion last year, and there's no signs of the business turning around anytime soon. So what they've done is created an independent subsidiary for that business. Obviously, they need more funding to upgrade the fabs to make sure it can compete with TSMC. But at least there's more transparency around how much money they're losing in that foundry business, what sort of gross margin profile it has. And it just, as an investor, it gives me more comfort to see, okay, how is the core PC business doing versus what is it that the foundry is losing? And, if they have to raise capital, then they can do that. So more to do with transparency. I don't think execution changes in a quarter.
Yep.
So it's a long story, but at least they're doubling down in the U.S. here. So they're stopping their investments outside of U.S. And what it suggests is that with the geopolitical tensions that there are, a lot of these hyperscalers will pivot to using Intel as a foundry, at least here in the U.S.
And, really what's the thought behind the play for investors that are investing in Intel? I mean, when you look at its competitors, we've got NVIDIA, I'm looking year to date, up 136%. We've got Intel down about 56%. So what is the play? What type of investor is still investing in Intel at this point?
I mean, the consensus is overly negative on Intel. Any hint of positive news is good for the stock. And look, they have to give incremental proof points as we go along. So this is by no means a turnaround in the making. No. You have to look at the incremental data points. Everyone thought hyperscalers are the ones who are spending over $100 billion in CapEx, who are raising their CapEx. Why is Intel not exposed to that? So now they have given a hint that maybe Amazon will give a small order. I don't think they are making all their chips with Intel anytime soon. And they're still going to TSMC for all the leading node manufacturing. But the fact that Intel could get a few orders from Amazon, it's a positive.
Is there a technical reason that Intel just doesn't have it to compete? Or
absolutely. I mean, it goes
they just
down
don't have the they just don't have the products that the customers want.
It's about the process node technology. When TSMC says they have a 3 nanometer at scale, where they're making chips for Apple, Nvidia, all the fabless guys, Intel doesn't have the equivalent of 3 nanometer. They're still trying to perfect that. They've lost a lot of engineering talent. Plus, their cost of manufacturing is 70% higher than TSMC's. So it makes it very hard to justify why would any company give an order to Intel for a leading node when the costs are higher and they're not even at parity. The only reason I can think of is the geopolitical tensions. What if something happens to Taiwan? That's where an Apple or an Nvidia or an Amazon would want to diversify their exposure.
I mean, and Intel really used to be a powerhouse. So, I mean, what would they need to do to really see some sort of comeback? Do they need to be a bit more innovative and start looking for something that's a bit more competitive? Or does it seem like it's pretty much a universal lost cause? Is that how Wall Street is viewing it?
I mean, look, the government is completely behind Intel. So there are very few sectors where the government really supports you in such a big way. Intel definitely has that tailwind in terms of government support, $8.5 billion in CHIPS Act funding, another $3 billion announcement. So they have all the support from the government. It's about making sure that translates into good yields, making sure their chips are equivalent to the likes of TSMC, and that's where the execution comes in. Do they have the engineering talent to turn around their fab manufacturing and their chips being competitive to TSMC?
Does Taiwan Semiconductor manufacture all their chips in Taiwan?
Yes.
That's a problem, dude. I mean, a Chinese and a Taiwanese boat bump into each other in the night. It could be all over.
Yeah, I mean, they have plans to expand in the U.S., in Arizona.
If I'm Tim Cook, I'm saying, here, Intel, here's the chip, just manufacture it. I mean, it's in my best interest, if I'm Apple, if I'm all these chip, to have Intel doing great, right?
Yeah, but then Intel also is a design vendor as well. So Intel makes a chip that's competitive to NVIDIA. So why would an NVIDIA have Intel manufacture their chip when Intel could also compete with it? And that's a problem that Intel has had in separating those businesses, because Intel is also a competitor to all these fabless companies, AMD, NVIDIA, and that's a challenge.
But again, if I'm a buyer, I want as many chip suppliers as possible, particularly ones that are like in Kentucky or Nebraska.
Maybe they need to divest. It's clear that the foundry business is run completely separately.
Our thanks to Bloomberg Intelligence Senior Technology Analyst Mandeep Singh.
Sticking with tech, let's move now to TikTok as a social media company continues to face scrutiny from the U.S. government.
The video sharing app went to court Monday, arguing that a potential divest or ban request violates the company's free speech rights. For more on the outcome of that hearing and a potential path for TikTok, Norma Lind and I spoke with Bloomberg Intelligence media litigation analyst Matt Cheltenham.
If TikTok wasn't concerned about a potential ban, it should be concerned after that hearing did not go well for the company. What's at issue here is in April, Congress passed a law that said unless TikTok is divested to a company that doesn't have its parent in China, that companies in the U.S. can no longer carry the app in app stores. Companies can no longer host it in a way that the app can be distributed, updated, or maintained in the United States, as of January 19th. And TikTok has said, look, we can't do a divestiture. It's certainly not on that timeline. And so TikTok's only chance to survive in the United States after January 19th is to win this legal case. And the three judges on the case, in my view, were not very sympathetic to the company's First Amendment case.
And so is this isolated to the United States? Are there any other, countries that are also trying to crack down on TikTok and its influence?
I think different countries are taking different approaches. The EU has taken a harder approach to tech regulation generally, and likely would apply that to TikTok without a specific ban in the same way, according to our analyst Tamlin Basin there. So this law is U.S. specific. It was passed by Congress specifically to target the company. And so it's a different remedy here in the U.S. But there's a tendency, I think, to think, nothing's going to happen in Congress. Nothing ever gets done there. Just a lot of talk. Well, here, Congress did it. It's done. It's law. And TikTok's only chance to overcome it is to win this legal case.
So the parent company for TikTok is ByteDance, a Chinese-controlled company. If I misstated that, let me know. What has ByteDance said about their options, what they plan to do, scenarios?
Yeah, so that's right. That ByteDance is the parent company of TikTok. Now, TikTok is a U.S. subsidiary. It's a U.S. company. TikTok is a privately owned company, but it happens to have its headquarters in China, and that's the concern. And TikTok and ByteDance in this legal case have basically said, look, a divestiture is just not technically or legally feasible. And so there's really no indication that they're pursuing a divestiture at this point. And at least that's their indication to the court. In fact, the law allows a 90-day extension if the president sees they're making progress on a sale. But the companies, they've made no indication they're pursuing that route. They say this is a blatant violation of the Constitution, and so they think they can win in court. But I'm not so sure after that hearing.
I mean, so what do analysts think are would be the broader readout for the corporate side of things? I mean, of course, we know so many companies actually promote their products and their companies on TikTok. I mean, when I'm scrolling through, I'm always seeing a new pitch. So what does that look like in terms of advertisement and the ripple effects there?
Yeah, that's right. And part of the litigation yesterday was brought by users of TikTok that say, look, there isn't a good substitute. Yeah, there are other social media companies, but we've built our businesses here. We are expressing ourselves as a First Amendment matter on TikTok, and the government can't take that away. And there's also a big business impact in terms of TikTok's competitors. TikTok is one of the leading social media apps in the country. So if it goes away, it's a great opportunity for the competitors, for Google, for Meta. And so there are serious business implications by forcing a divestiture that isn't going to happen and effectively forcing a ban.
Is this something that could get to the Supreme Court?
Yes. So if TikTok loses in the D.C. Circuit, I expect we'll see a decision by early December from the D.C. Circuit. As I said, the key deadline is January 19th here. So there's not a lot of time. If we see a decision in December from the D.C. Circuit, TikTok's realistic only chance at that point is going to be a last-ditch plea to the Supreme Court to hit pause on this, to say, look, nothing should move this fast when you have such a major restriction under the First Amendment. The Supreme Court should issue a stay and take up this case. That's going to be TikTok's last chance to dodge a ban by January 19th if this ruling goes against it. And I'm not sure the Supreme Court will necessarily take it. Yes, it's a major question that they might be interested in. But if TikTok gets a major loss at the D.C. Circuit, the Supreme Court could say, look, they got it right. We don't need to step in here. So it's not even a sure thing that the Supreme Court will take it. We'll have to watch that in after the D.C. Circuit rules.
Our thanks to Bloomberg Intelligence media litigation analyst Matt Cheltenham.
Coming up on the program, we take a look at commercial real estate and one site in Brooklyn that's working to perfect the foot traffic floor plan.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move now to commercial real estate and one site in Brooklyn that's making their way in the tough New York City market.
Jim Somoza is the managing director of Industry City, a multifaceted shipping, warehousing, and production space on New York's Bay waterfront. And we spoke with him about the space's success.
You know, we have a lot of history doing adaptive reuse projects like this, like Industry City, like Chelsea Market, which at one time, just like this project, was, you know, a number of older buildings that were past their prime, but people really like classic old buildings that you take and redevelop into offices and retail and things that are fun. So we've seen this before, and we've done it at other locations. So look, I'm surprised we took on something as large, if you really want to know, that's 6 million square feet, but we've been able to do it. So from a success standpoint, I'm not surprised.
Jim, talk to us about how you're thinking about real estate, mixed-use real estate, office real estate, in the context of what appears to be a post-pandemic, you know, different way people work and live and go to the office and all that kind of stuff.
We've been at this since doing exactly what we do, which is adaptive reuse and activation and fun place, you know, creating a fun place to work for a long time. We didn't know a pandemic was coming. It just it so happens that it came, and what we do is more attractive to people. So what we do here is create a place that people like to come and work. And so we've actually been at 80% of the employees that work at IC have been back in the office regularly for several years now. And so you know, that's kind of what we do, is create fun places to work that are not commodity real estate. I worked in many glass and steel office buildings in my career, and these are just more fun places to work. And people like coming to work when they come to places like this.
How do you know when a project's going to work, right? Like you mentioned Chelsea Market and then Industry City. Like, what's the secret sauce?
I will tell you, the secret sauce is, so what you first do is you start with the ground floor and the placemaking. And for us, when you do something like this, when you have a project, you need retail, you need food and beverage, you need shopping, you need things like that. But how do you do that without any foot traffic? Nobody wants to come and do retail with you when you do that. So what we did at Chelsea Market, and the same thing here, is we went to wholesalers and commissaries and bakeries and things like that. People that really were interested in the production space more than retail, but they had to do retail with us. That was part of the deal, you know, and we gave them a favorable rate in the beginning to do that. But they needed ground floor space. They needed space that had plenty of loading. Getting priced out of New York City was something that they didn't want. They wanted to be near their customers. So we would go to those, and you go back to Chelsea Market. Lobster Place was a classic example, wholesale fish, seafood place. For us, it was bakeries such as Colson's and Lilac Chocolates and things like that. Companies that really were interested in production space, but we wanted them to do retail. So that way, they're two businesses. You don't have to worry about the foot traffic in the beginning while you're getting this going, but you're starting to get retail and amenity type tenants on the ground floor and placemaking, and that's how you start to lease the upper floors. Once you start to do that, then you have tenants in the building that are just happen to be right next door to those retailers, and then the retail takes off. And if you're to answer your specific question, how do you know? You know when those folks, who, by the way, didn't really want to do retail with you in the beginning because you didn't have foot traffic, you know when those folks come to you and say, "How can you do more marketing for me? And can you get me more foot traffic? This is fantastic," because they're doing, you know, retail margins instead of wholesale margins in their space. As soon as that happens, that's when you know you got something.
So, Jim, how about on like the corporate tenant side? What type of companies want to be in a space like yours?
So we tend to have more creative type companies, lots of designers, architects, marketing firms, things like that. You know, that's kind of very consistent with the Brooklyn market. we have a lot of that. We are starting to see some more traditional type of companies like finance firms and law firms and things like that, which we did not see in the beginning. But we have a lot of that. We have a lot of industrial. We're 6 million square feet, first of all. So that's a lot of space to fill up with, with just one or two types of industries. So we have a lot of distribution and warehouse still. But our office itself focuses more on creative companies. And then we have people like the Brooklyn Nets, so the Brooklyn Nets, their headquarters and player personnel and back office are all here. So it's really, it's a much wider range of types of companies than you would normally see in a project, partially because we are 6 million square feet and 16 buildings. So we have the ability to do things differently building by building that you may not be able to do if you were one or two buildings.
Our thanks to Industry City Managing Director Jim Somoza.
We turn now to banking, where new FDIC policy could be heightening the hurdles for future bank mergers.
For more, we're joined by Bloomberg Intelligence Senior Policy Analyst Nathan Dean.
Yeah, so essentially what it says is that it's going to place more emphasis on certain aspects of bank M&A, like the impact on communities, competition, and so forth like that. And it changed the parameters that the FDIC in particular is going to look at when going forward with approvals. So if I'm Bank A and I'm trying to merge with Bank B, and as part of that merger, the FDIC, for example, decides that the south side of Chicago is going to be harmed, either due to branch closures or lack of competition, the FDIC is going to come in and say, no, you can't do this. It should also be noted the Office of the Comptroller of the Currency finalized something very similar, not exactly the same, but essentially what we've been telling our clients is this. One, you've probably anticipated that bank mergers was difficult under the Biden-era regulators. That's going to continue. And two, this is easily reversible. So if President Trump wins in November, new leadership at the FDIC and the OCC next year could walk some of this back if they so choose.
Is this a solution in search of a problem here? I mean, if we had a swath of bank M&A that's disadvantaged people, have I missed that?
So, there's really two sides to this story. The first side is that a lot of this hasn't been updated since 1995 and 2008. So the Biden-era regulators and the FDIC in particular say, look, this is what we're just doing is codifying already what we're looking at. We're just making sure that it's now on paper so that banks are at least more transparent, or at least get a little bit more transparency in terms of that process. If you talk to the bankers, they're like, look, it's been difficult to begin with. And, going to let's say the Capital One Discover merger, this may not be so much of an anti-competitive issue, or there's not going to be much of a community impact. So it's really which side of the story do you believe in and which side of the story you are talking to. But again, this is a codification of already existing, I think, theory and already existing behavior. Mm-hmm. And again, something that could change under a Republican administration.
I mean, that was totally one of my questions that Paul took, was like, what problem is this actually trying to address? And to the same point that recently we've had bank issues, just Jamie Dimon winds up buying the bank on a discount helped by the government. So, is that helping any of those problems?
No, and you bring up a great point. There were several comment letters to that, exactly saying, look, you put these, and these are some of the bank comment letters saying, look, you put these processes and these procedures in place, but then when the market goes down, we buy a bank over the weekend and you throw the playbook out and you say, let's just save the system. And so the bank's response is somewhat frustrating here. They're frustrated because in their eyes, the regulators put out these procedures, these processes, they put everything on paper. And then, when the market goes down and a solution needs to be found on the fast, they just, throw that all to the wayside and go forth. Ultimately, though, this is a little bit more of what we're seeing, though, with just democratic financial regulation in general, placing more emphasis on the community and the individual. Because before, when these bank mergers would have happened, you'd look at capital levels, management, risk to the system, and so forth like that. But now they're looking at the individual impact. Are people on the south side of Chicago going to be harmed by this? Are prices going to go up? So it's more of this economic populism side of the Elizabeth Warren side of the Democratic Party that's now making its way into these policy statements and these rules at the banking regulators.
So have we heard anything from the industry per se? Because one of the things I guess at least I learned during the recent round of weakness and failures of some of these small banks in the last couple of years was there's 5,000 small and community and regional banks out there. That's a lot, relative to Europe, for example, which doesn't employ that branch system as much. A lot of people are saying, aren't there too many branches anyway? Aren't there too many banks out there anyway?
You know, it's funny. I was actually looking at the number of banks on the terminal, and, since 1980, it's gone down fairly significantly to that 5,000, so level. But to your point, yes, that is somewhat larger compared to other countries, and there are a lot of small and community banks. But I would also just remember, small and community banks, and, we usually use the term community banks for 10 billion in assets and below. These community banks usually have broad political support amongst both sides of the aisle here in Washington. Nobody wants to be seen throwing capital requirements or heavy regulation on a small community bank because there are a lot of aspects of this country where they're the only places that offer credit to farms, small businesses, and so forth like that. A lot of the big banks are, centralized in these cities. So, it's just a debate that both sides pay attention to. But what we're telling our clients is this, is that bank M&A is hard today. It will be hard tomorrow because of this. It will be hard tomorrow if Kamala Harris wins the presidency. But if President Trump wins the presidency, the layers to the onion could begin to peel off, and bank and M&A could be a little bit easier, say 2, 3, 4 years from now as a result of that.
That's just must be so confusing as a CEO or a CFO of a company, because you have to make a business plan today that may or may not have the same rules in play in 18 months.
Yeah, absolutely. I mean, just look at the Capital One Discover Financial merger. When that came out, the CEO of Capital One came out and said, look, we think it's going to be, resolved by the tail end of 2023. Here we are sitting in September, and I'm not sure many people believe that. So the idea here is that, a lot of companies want to have these speedy access to mergers. They want to be able to get it done. And from a, paper perspective of looking at it from the size, a combined Capital One Discover card size is still going to be below PNC. You're not going to have what's called a GSIB, one of the biggest banks as a result. So that should be fine. But ultimately, what the regulators are doing now is they're looking at, certain areas of the country saying, and I pick on Chicago because I'm from Chicago, is the south side of Chicago going to be harmed by this? And they're going by postcode. And if they think that there's issues there, they're going to slow the process down, investigate it even more, and it's much to the frustration of the banking industry where they just want to get these deals done and move on.
Our thanks to Bloomberg Intelligence Senior Policy Analyst Nathan Dean.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.